Hello, my name is Osman Dawud. I go by Ozzy. I'm the technology director at San Francisco Community Land Trust. And today we'll be walking through an overview of a critical real estate function, asset management. And so broadly, that can be viewed as, managing properties really for long-term financial and compliance and then mission-aligned performance. We'll get much deeper into the definition of that. Real quickly, before we get into all the details, I want to walk through a brief disclaimer that I've written on this slide. And so, this session is really presented for informational and educational purposes only. And the views, thoughts, and opinions expressed here are those of the presenter and myself and do not necessarily reflect the views of SFCLT. The information presented is for educational purposes and should not be considered a substitute for professional advice. Thank you. So I want to give a brief overview on San Francisco Community Land Trust, which is the organization I work for, before we get into the asset management details. So SFCLT was formed in 2003. We currently own and operate 16 buildings across roughly 180 units of permanently affordable housing, all of these being located in San Francisco currently. We also lend technical support to other CLTs and small developers across the Bay Area. So through this presentation, I want to walk through a number of things. First I want to introduce what asset management really is, and then I want to go through some of the core competencies that are really needed to perform asset management in a community land trust context. And then I want to go through an overview of some of the different potential key areas and responsibilities. These tend to differ by organization and, various needs and compliance, etc. And then I want to go through a very core asset management principle, which is debt service coverage ratio. And then we'll go through a few examples of processes. So, number one, we'll talk through and go through an example of a budgeting process. And then we'll perform a property financial analysis review together. And then we'll briefly bring it all back into a final summary and conclusion. So, what is asset management? So, asset management is a term that I feel like gets thrown around in a lot of different contexts. And I, often wonder what people are referencing. And so, we have defined asset management in a certain way. And before we get into that, I'll note that different organizations tend to define it differently. And some organizations may include other functions, some may not. But I think this is relatively representative of how most organizations think about it. And so we really view it as the strategic oversight of properties and resources to ensure, number one, their long-term financial sustainability, number two, regulatory compliance, and then three, we want all of that to be happening in alignment with the organization's mission. And so when I'm talking about financial sustainability, I'm really talking very concretely about wanting to make sure that each property has what is called a positive debt service coverage ratio. And we'll get into that definition a little later. But very simply, you want to make sure all of the income is greater than all of the expenses, including debt service. So there is a cash surplus. In addition, we also want to make sure that there's sufficient funding available for capital improvements to make sure the building can maintain a high quality of living. And we want to do this all through the property's finances, so without having to touch the core organization. And that really is a financially sustainable building. With regards to compliance, we want to make sure that we're really adhering to all of the different requirements, and those can be across a number of legal agreements. First and foremost, loan documents, the leases we have with our residents. Depending on if it's a co-op, there's often cooperative agreements, and then there's always state law, and we want to make sure we're following all of these different regulations and requirements to make sure we are in compliance, so there's no legal risk and being out of compliance definitely, can be problematic, and I'll touch on the risks after the slide. And that third component I have here is really about mission alignment. And so, one part of that is like successfully doing the first two things I just mentioned really allows the organization to be in compliance, have financial flexibility, and really focus on the mission. It can factor into decisions more, right? For example, if you really want to have a high quality of living, if you are operating financially sustainable, there is more money to invest more into your residents and their quality of life. I would also say, a critical part of asset management and overall community land trust work is the residents and having the ability to participate through stewardship. This won't really be covered here because it's going to be discussed in a separate stewardship and resident education video. But of course, that is a very central part of managing any real estate property for a community land trust and affordable housing organizations broadly, potentially. So now I want to go down to these objectives at the bottom, and I've tried to lay out very succinctly, like what are the key outcomes that we want to focus on from an asset management perspective. And more or less, if we do these things, we are doing asset management at a high quality and we're succeeding. And again, the first one is around the debt service coverage ratio, which I will go into much more detail later in this. But we want to always achieve a debt service coverage ratio that is greater than 1.15 for every single property in the portfolio perpetually. And this basically means that the net operating income is greater than the debt service by at least 15%, and there is that cushion every single quarter or year to cover our debt obligations and any unexpected expenses that arise. We have coverage, and the building is operating at a cash surplus. Number two is around capital improvements. So we want to make sure that our reserve accounts cover all needed capital improvements. And we want to do this through really strategic deployment and really sufficient capitalization. And so most commonly, um, real estate deals and CLTs will have what is called a replacement reserve account. And we want to make sure we're using that effectively to make sure we can cover all the improvements that are needed over a very long period of time and really perpetually, to make sure we can continuously improve the overall condition of our buildings. Number three relates to compliance. We want to make sure we're just in compliance with every single term and all of the various legal agreements that I mentioned. And then number four is around mission alignment. And we want to ensure that all of our units really are permanently affordable. And so, a commonly used definition of that is, 20% below market rate and ensuring that our residents are not rent burdened. And we really want to do this to make sure that we are actually providing affordable housing rather than just housing that is equally as expensive as the market, but, provided by an affordable housing. We want to make sure it's actually affordable, very central to the work we do. And so just to summarize, asset management for the sake of this presentation, we're really going to be focused on financial sustainability and compliance. So I want to talk through, some of the risks associated with asset management. I think first of all, asset management is a very high stakes department. And what I mean by that is poor asset management has, meaningful consequences for a community land trust relative to a lot of other functions, I would say. And so I've created two different tracks on this slide, showing what can happen over time with, poor results. And so starting on the left-hand side, we can talk about, number one being a lack of financial sustainability. And so what does that mean is, the property operates at a DSCR below one. So, there's insufficient cash to cover the debt service and potentially insufficient reserves to cover the capital improvements. And so what would happen? Immediately, it would require an injection of core organizational funds. This will be needed just to sustain the property operations and complete just the necessary capital improvements. And so without that, we, literally would not be able to cover the expenses for the property, things like utilities, property tax payments, and, we need to cover those expenses on a regular basis. And this would really constrain the organization already to, use those funds for other mission aligned projects. But if this continues, what's going to happen is it's going to require a really large resource allocation, a significant allocation of both staff time and organizational finances to resolve this problematic financial situation. And while that's happening, what's likely going to happen is the property is going to continue to deteriorate. And this is because we don't have sufficient financing to do all the capital improvements that we want to do to ensure our tenants have a high quality of life. And I want to jump to number two on the compliance side, and then we'll bring the long-term and catastrophic risks together. So go to the right-hand side, a completely separate risk on the compliance side, right? Being non-compliant with any legal regulations. And so we're not complying with all of the requirements from one of the various agreements. So what can happen immediately? There can be lender and auditor penalties, right? There can be financial consequences from lenders. Often in some of these deals, they can put fines on. They'll have tighter restrictions. On your annual audit, there will be a flag on the audit that your organization is not in compliance. And if these things continue, that can really lead to a failed public audit. And, that is very, very detrimental to any organization, let alone a community land trust. And in addition, that's going to likely lead to some other reputational damage. And, I think funders and lenders will be less likely to want to fund your organization because they review organizations' audits at the time of considering providing funding. But all of these things, if the financial sustainability issues or the compliance issues persist, really in the long term, it can lead to significant financial hardship for the organization. It can lead to the organization having to default on that loan. And then, depending on the terms, that may mean that um, property is now going to get sold in the speculative market. And it will make it very difficult going forward for the organization to acquire additional property. And ultimately, given this is financially driven, it really can lead to the organization going bankrupt, and that will mean a failure to execute the organizational mission, reduce residents' ability to receive affordable housing, and really it'll support this, current negative sentiment that community land trusts can't operate real estate holdings, which, we believe is very inaccurate and often other people with motives to, have us not succeed. And so we certainly don't want to reinforce this inaccurate point. And so just to summarize, it is a very high stakes department. It's very important to be proactive on financial sustainability and compliance to ensure your organization does not have any of these risks and issues. So now I want to touch briefly on some of the core competencies, we think that are sort of associated with asset management. And this is the perspective of the sort of skills that the people that do asset management, tend to need to have to be able to do it effectively. And I've broken this down into three categories: technical, hard, and soft skills. Starting with the technical skills, I think having some sort of financial acumen is very helpful. So just the ability to read pro formas, financial metrics, understand budgets, cash flow analysis. Number two is some regulatory and compliance knowledge. So, it's good to have a background in that, but definitely people need to develop deep expertise in all of the loan documents and various other legal agreements to make sure they understand all of the compliance associated with managing your real estate holdings. And I think it's very helpful to have software proficiency just because a lot of this work tends to be done through spreadsheets or various other softwares, such as, there's a lot of property management softwares and asset management softwares. And so having the ability to use these, I think, is very helpful. Next, we'll go to some of the hard skills. I think it's important to be able to, create and use various tools, right? Those will streamline workflows, improve efficiency, um, an understanding of data analysis and reporting, right? So a big part of the financial sustainability portion is really reviewing, reports hopefully generated by your accountant regarding the profit and loss of a building, being able to analyze that across the portfolio and communicate that to often non-financial stakeholders, whether that's other staff, your board, residents. It's a big part of what community land trusts do. And then just, being able to have operational oversight over all the different areas. Risk management's important, as we had just looked at, identifying these risks early and being proactive. And then some of these soft skills I think are just good for anyone in a community land trust, but certainly in asset management, just having leadership and ownership, good relationship management. There's, lenders, there's property managers, there's residents, there's auditors, a lot of people that, asset managers tend to interface with. Important to be very structured and organized and systematic with all of your work. And having empathy and judgment, I think, is very important, especially as an asset manager, because really, when you're a CLT asset manager, you want to be balancing resident needs with financial sustainability needs of the organization, as opposed to just focusing on financial sustainability. And so just to summarize, it's a very highly specialized field. It requires a lot of understanding. I don't think you necessarily need to have all these skills going in, but very important to develop these skills to be able to effectively manage the portfolio, especially as it grows. So next, I want to walk through some of the potential, key areas and responsibilities associated with asset management. And I'll note that, this tends to differ by organization depending on the different functions and what they define is included in asset management. So some organizations might separate out compliance, they might add construction management, etc. And then B, depending on the compliance in your specific city and state, it, can potentially, you'll have different compliance needs. But this is a rough framework and, how SFCLT approaches it. And so you can see I've split this out into roughly four categories. Number one is acquisition and refinancing. Number two, compliance. Number three, around, financial sustainability of the, existing acquired portfolio. The number four is some other functions that, have overlap with asset management, but are distinct. And so we won't go into too much detail here. And so starting with acquisition and refinancing, you can see I've, split it out into three sort of different responsibilities. And the first is around acquisition support. And so for SFCLT, we typically have a small development team who really leads on finding and acquiring new buildings. And so the asset management team really provides support related to financial modeling, so looking at the pro forma and the assumptions, and then doing loan document review. And this is really because, once the acquisition is completed, the asset management team is going to be responsible for this building. And so just want to make sure that we're all on the same page with all of the assumptions and everything stated in that loan document. And that goes to the next one, which is really the transfer from the acquisition team to the asset management team. And so really overseeing that entire process of, a new acquisition and bringing that building in to the asset management systems. And so that might be updating some tools, reviewing the budget, if you have third-party property managers, which we do, ensuring they're up to speed on the building, making sure we can stabilize it, so get it to a point of it being fully leased up and generating a positive cash flow, all of that kind of stuff. The third thing is around refinancing. And so really managing all the refinancing events and ensuring that you can secure new financing in anticipation of all loan maturities. And so typically, often we're getting loans that are maybe 10 or 15 years, the actual duration, but it's amortized over 30 or 35 years. And so the point being, we have to refinance that. And so we have to find new financing right before the previous one matures. And that can often take 6 months or even a year sometimes. And so really good to be organized with those dates and proactive on that. And so next I want to talk about compliance. And so I have a note, as you can see, that a lot of the key areas here touch compliance, but you know, the things that are core compliance things I've included here. And so I don't want to get into too much detail on all of these because, the compliance needs differ by organization. But, here's a list of a lot of them. So, we do LLC creation and business registration. We create a new LLC for every single property that we acquire. Welfare exemption, which is very important for CLTs. This is a process we go through to ensure we are exempt from the majority of property taxes because we provide affordable housing. So this is a really big financial advantage that affordable housing has compared to for-profit developers. And then we do an annual audit, which all organizations need to be doing. We have tax filings. We have property tax payments twice a year. We have lender reporting. Majority of loan documents will require some amount of lender reporting, typically providing quarterly financial statements and annual budgets, making sure we're managing our security deposits for residents in compliance with state law and any restrictions in loan documents, and then any other legal related matters that, a CLT may have to deal with. So now I want to focus on some of the financial sustainability areas. And you can see I've split this again into four different categories within. And so this first area is really these informing analyses. And so that's really the process of creating budgets and then using those budgets with the actuals to perform a recurring cash flow analysis. I won't touch on these too much now because I want to go through some examples of doing these later, whereas the other areas, we won't have that ability. And so the next area is around, areas where you want to really maximize your income, right? When we think about financial sustainability, it's really maximizing the income, minimizing the expenses to ensure there is more income than expenses. And so making sure you're administering rent increases across your portfolio in compliance with your loan documents and doing it on the correct cadence, marketing and lease ups and vacancy. We want to make sure we're filling all the vacant units as fast as possible. So we need to be really proactive and organized on that front. Bad debt, we want to perform an annual bad debt write-off, and then we also want to, reach out to those residents that are not paying their rent to, potentially create a payment plan or understand what we can do better with them. And then we at SFCLT, typically charge various organizational property fees. So, for example, we charge an asset management fee for the work we're doing. This allows us to bring some income back into the core to allow us to, maintain our core operations. And so our lenders have strict requirements around how much that is and what the increases are. And then the last fee that comes to the core organization is really around developer fees. And so we just want to make sure we're doing all the work that, our lenders need us to do so we can earn those developer fees, which are very central for a community land trust to maintain their core operations as a critical income source. And then we can look on the expense side on minimizing expenses. So insurance costs have been rising very rapidly in California in the past years. And so very good to be proactive. And we have our own insurance broker that we work with and really want to make sure you can get your insurance well in advance of expirations on current policies so you can really shop it around and get the best deal. Next area is expense requests. And so, for example, we have third-party property managers that, send us proposals for various maintenance and other work that has to go on in our building. We're approving those, making sure it's in accordance with our budgets, and we can make sure that we'll end up financially sustainable. And then expense reduction, when there are problems and expenses are rising and they're much higher than the budget, developing plans and implementing expense reduction strategies just to make sure we can get those back to the budget. And the last area is around, managing some of your assets. So, we tend to have different reserve accounts. We tend to have, a replacement reserve, as I mentioned, which is really for, the capital improvements over the 20 years. I believe there's a separate video about capital needs assessments, and so that'll go much deeper into this. And then all of your bank accounts, making sure there's sufficient funding in your various property accounts to cover all the expenses upcoming. And then this last area of other functions. So a lot of these functions have some overlap, and often asset management is overseeing, but they are distinct. And so, one being construction management. For us, that's really completing the rehab and the big capital improvements. And so making sure that's in accordance with our pro forma, the budget we have from our lenders, etc. We oversee our property managers, so we meet with them biweekly to make sure they're staying on top of all the resident needs. We're making all the improvements. They're being very responsive to any issues, etc. And capital needs assessment, which is, in a separate video, but really a, often 20-year sort of projection of the capital improvements that will need to occur. And then the last one is pro forma developments. This is related to acquisition support. And the pro forma is really the core financial document that is the, foundation for asset management for the, 10, 20-year period. And that's also going to be discussed in a different video. So we won't go too deep into that. So a lot of different key areas and responsibilities in asset management, all on different cadences. I think asset management is a very complex area, and so very important to be organized and efficient and have good systems to make sure you can really manage all of these different areas. So now I want to go into one of the core asset management principles, and I'm sure everyone hears all the time DSCR and maybe has some understanding of what it means, but I want to go really clear into what it is. And so that is the debt service coverage ratio. What this is a financial metric to measure the property's ability to generate enough income to cover its debt obligations. It's a very important asset management principle, and from the standpoint of lenders, it's the most important metric they are constantly looking at, not only when they're considering giving you financing, but really over the entire life of the loan. And so, how is it calculated? So, debt service coverage ratio is calculated by taking the net operating income divided by the debt service. And the net operating income is the total property income minus the operating expenses. And operating expenses does not include debt, but includes all the other expenses. And then debt service is the total of all the loan payments, inclusive of both the principal and interest portion. And on the next slide, we'll go through examples to make sure it's very clear how to calculate. From the lender perspective, lenders in our experience typically require a DSCR of 1.1 to 1.15 roughly. This means that the property basically has a 10 to 15% more income than needed to cover those debt payments. And so it provides a buffer to protect against unexpected income shortages, rising expenses, or any meaningful vacancy fluctuations that can, commonly occur, across affordable housing. So just to summarize, it's really a metric to show that you can cover your debt service with your net income. And so I want to talk through some examples of calculating it and then also different scenarios of DSCR. So starting in the top left, having a DSCR that is less than zero, sorry, so it's actually negative, is critical risk. This is the most concerning. This basically means that your operating expenses are greater than your income before you even get to debt service. So in the example, we can see the, total income is 180,000, and then the operating expenses, which again doesn't include debt, is 200,000. So you're already operating at a $20,000 loss. And then in addition, you have this $150,000 of debt service. So if you take negative 20,000 divided by 150,000, you end up with negative 0.13. And this is the most concerning scenario. This is very rare. If this happens, there are major issues, and immediately it's a very critical analysis that has to happen to understand what has to happen to fix this. And the next scenario is high risk scenario, number two. And this is when basically you can see that your annual income is greater than your operating expenses. So here you take 300 minus 170 and you have a net operating income of 130,000, but your debt service is 150,000. So while you do have a positive net operating income, it is still insufficient to cover your debt service. So if you take 130 over 150, you get 0.87. And so your DSCR is greater than zero, meaning you have a net operating income, but it's less than one, meaning you still can't cover your debt service. So this is still a high risk situation. You do not have enough money to cover your debt service. It'll require some sort of a subsidy, and immediate work has to happen to resolve this situation and get that debt service coverage ratio above one. Now, in the third scenario, I've called it the caution scenario. It's when the debt service coverage ratio is greater than one, but it's still less than 1.1. So it's pretty tight. You can cover your debt service, but there isn't a big cushion. So you can see here the net operating income is 160K and the debt service is 150K. So you do have adequate coverage, but there's a very small buffer. And so if there's any unexpected expenses or vacancies, this could very quickly become a DSCR in the high risk scenario that's below one, right? Like the 0.87. And then the last box, which is the strong DSCR, is really where you want to model and ideally have your entire portfolio, which is a DSCR that is greater than 1.1. So in this example, you can see the income is 400,000, the operating expenses is 220. So your NOI is 180, your debt service is 150. So 180 over 150 is a DSCR of 1.2. And so this means you have healthy coverage, you have a 20% cushion, it'll meet all the lender requirements, and you have a lot of operational flexibility for unexpected expenses. If there's additional investment you want to make to improve the quality of life of your residents, you'll have that cushion and you can feel good about, where your financials are for your building. And so that's ideally where you want to be at. Often it's not the case, but this is what we want to strive for, at least greater than 1.1. And 1.2 is obviously a great DSCR. So the next area is property budgets. I want to go through now, walking through what the process of property budgeting is. And then I want to talk specifically through an example of that. And so we'll pull up a spreadsheet and actually go through it. So what is a property budget process? It's really the process of like developing property budgets that accurately project your operating income, your expenses, cash surplus, and ensuring that it really meets the budgeting requirements of your lenders. And so often they have DSCR targets. There's a specific waterfall of, what cash to surplus should go to. And you want to do this across your entire portfolio every single year. And so for us, this process typically begins in September, October, for the following year. So you want to make sure, yes, that, projections are accurate and they meet all the lender requirements. Um, the purpose of this is really it's a critical tool for financial analysis throughout the year. So if you have accurate budgets throughout the year, you can just be comparing the actuals with the budget, and then any big variances is where you know the problem is. And then you have to figure out how you can reduce those expenses or what's gone on, what's different than what should have happened. And so without an accurate budget, you really don't have a source of truth to compare what the financials throughout the year should look like. So it's a very critical tool for financial analysis. And then also for, compliance and lender needs, just having a budget that shows DSCR, which is, the target they need, will appease them and make it clear that you see a path to a positive DSCR and making sure you can cover your debt obligations. And then I would say, what is the risk? Like, poor financial analysis can really lead to financial instability, right? So inaccurate projections lead to an inability to understand what the income and expense line items should be. And then, that can often lead to a negative or below zero DSCR. And then, you really don't have a clear tool to understand where the issue is and how to create a good plan. And then on the compliance side, it might not be in compliance, and you can have concerned lenders that don't see a path and may want to take a more active role in the day-to-day, which can, create much more capacity issues on your side. So I tried to lay out again some simple objectives. You want to make it timely. You want to make sure this is done before the, budgeting year starts. So if you're making a budget for 2026, it's got to be done before December 31st. Um, you want to use the actuals. You want to project it based on the actuals from the previous year, and also removing sort of one-time income and expenses. But this provides the most accurate data as opposed to using maybe projections that were done 5, 6, 7 years ago. And the assumptions just need to be accurate and informed. And then you want to make sure this entire budget is in compliance with all the legal documents. Again, if there's DSCR requirements or other things like that, you want to make sure your budget includes all of that. So now I want to pull up a spreadsheet and we can go through an example of, the process of creating a budget. So I've pulled up an example budgeting process, and I want to talk through, conceptually how, we at SFCLT tend to create our budgets. And so you can see here I have an example building and I have a series of calculations that I'll go through. And so first, just starting in column B, this is our standard chart of accounts. This is basically, walking through all of the different categories of income and expense that, we have. And so you can look at, residential gross potential rent, and then the vacancy loss and bad debt that gets you to a total residential income. And then, some other income sources, right? Some buildings have, laundry income and parking income, and sometimes there's other miscellaneous income. And that gets you, a total operating income. And then we have all of our different operating expenses. So we have, all of our maintenance and repairs. We have utilities. We have various management fees. So property management fee that goes to our third-party property managers, and then some fees that go to us to cover our core, and then various taxes, insurance, licenses, and then some other expenses, legal, other miscellaneous stuff. And, certain requires and loans will have, reserve accounts. And then sometimes as part of that, you have to deposit a certain amount each month or each quarter into that reserve account. And that sort of gets you your total operating expenses, and that gets you the net operating income, which again doesn't include the debt. Then you have your debt service, and that gets to the DSCR. And then, you can see your cash surplus. And so our chart of accounts is standard across our entire portfolio. I recommend for all organizations to try to develop a standard chart of accounts. It allows you to do better analysis across your portfolio in a more efficient way, and you can easily have, one spreadsheet with all the finances. And so now going into the budgeting process. So at SFCLT, how we tend to do budgets is we will start this process typically in October. And what we will do is we will take basically 3 quarters of data. So January till the end of September is 3 quarters of data. And so everything highlighted in green is really the actuals for this 2025 year. And we'll be doing this in the context of creating a 2026 budget. And so I have the actuals for all of the line items we just talked about for 9 months of the year. And so just looking at this quickly, it's positive. It's great. It has over 1.1 DSCR. It's 1.26. That's again taken by, um, sorry about that. But yes, you can see that. And that's calculated as we've done already with the net operating income over the total debt service. So we start with the actuals for the 3 quarters. And then basically what we do is we first prorate that for a full year. So we take all of these numbers and what we do is we divide them by 9 because it's 9 months worth of data. And then we times that by 12 and because there's 12 months in a year. And so this gives us basically a full year projection of 2025 financials based on the first 3 quarters because we want all of our annual budgets to be for 12 months. So it just allows us to extrapolate what 12 months will likely look like based on 9 months of information. And you can see, everything's just increased by, 3 additional months. So the DSCR is the same, but, everything's gone up by that amount. And then the next thing we do is basically we will determine what the annual increase should be for every single category. And so I want to go into this budget calculations tab to talk through some of that. So first of all, what I'll do is I'll find a sort of standard annual inflation projection number. And so I'll, do some Googling for what's the US federal guidance for, what they expect inflation to be for this following calendar year. So for 2026, I, found a number that said, 3.1%. And the, US Bureau puts that out. And so by default, I'll start by putting all of these numbers at 3.1%. So I'm assuming everything's going to go up by 3.1%. But you can see there's some numbers here that are not 3.1%, like this and this and this. But I start with them all being 3.1%. And then I basically go through our loan document and understand what are the specific requirements around what line items. And so, for example, right, our loan document in this scenario states that there's a specific formula for rent increases. And so we basically have to take the change in operating expenses, and it's capped at 3.5 and a minimum of 2. So I plugged in our operating expenses for the past few years. I got the operating change. And so that means the rent increase is going to be 2.49%. And so I've plugged that in into the residential gross potential rent. I have the 2.49% instead of the 3.1%, because that's how much our rent is actually going to go up by, as opposed to the standard 3.1%. And then these are a few other examples. It'll differ depending on, what's included in your loan. But for example, our loans talk about our asset management fees that increase by 3.5% every single year. So if you look at asset management, I've changed that to 3.5%. And I typically like to add a comment for anything that's a little bit different than the standard inflation, and I can kind of explain why. And like another example, our loan document in this situation states that we must make a deposit into the replacement reserve of $2,400 every single year. And that doesn't change. And so I don't have an increase on replacement reserve because we put 2,400 last year. We're going to do that again this year. And then I'll, typically look through and see if there's any other categories that I feel like there's a reason to make a big difference. And so all of these repairs, I think inflation makes sense. For utilities, you can look up if by this time, the company that gives you your utilities has provided an increase for the next year. Sometimes they do, sometimes it takes a little longer. For this sake, I've kept it out of inflation. So another one that I changed is insurance, just because I am the asset manager. I've seen our insurance costs rise pretty rapidly over the past few years. And so I reach out to our insurance broker and he tells me we should expect a 10% increase next year. And so I've put that number in instead of the standard 3.1%. I think fees, inflation is reasonable. Talked about reserves. And then our debt service, right? I think for a majority of loans, your debt service stays constant throughout the entire loan. That's the case in this example. I would say there are certain loan agreements that, have a variable interest rate. And so that can change the debt service every year. Or sometimes it's only interest, only payments for a certain period, and then you add the principal. So that can also change it. So it's good to just be mindful of those kinds of things. So then this last column is basically taking column D, the full year prorated numbers, and then adding the annual increase to create that 2026 annual budget. So you can see the formula, pretty simple. And this basically gets us the first draft of the 2026 annual budget. And so you can see total income 112, operating expenses like roughly 53,000. So we have a net operating income of 60,000. And then very important then to see what the debt service coverage ratio is. So you can see here it has gone down from the previous year of 1.26, it's down to 1.17, but it's still above the 1.1. Our lender here requires a 1.1. So I feel comfortable with this. And so I feel comfortable with this as a final budget, and it has a surplus of roughly 9,000. And so if you're wondering like why the debt service has gone down, so a few things that you can look at. So asset management fees are rising faster than the rest. The insurance is increasing much more rapidly than our income. And then the general inflation number is also higher than our income increase. So, over time, if your expenses are rising significantly faster than income, you're going to see the DSCR drop. And ideally, it's not the case every single year. We are, currently in a higher inflation environment. So, this is common these days, but, hopefully in the long term, inflation is supposed to be closer to 2%. But if for say, the DSCR was significantly lower, let's say it was zero point 0.8 or zero point 0.9, what I typically do is I try to look at categories that maybe had a big one-time expense. And so repairs is a good example. And I'll try to look through our general ledger that, goes line by line for every single expense in this category. And then I look through and, maybe there was this one-time big bathroom repair that, we're not going to expect in the future years because this bathroom hasn't been touched in 20 years and a very long-term tenant moved out or something like that. Or maybe there was a big pest control issue, but it only happened last year. It hasn't happened the past 5 years, and we don't expect it going forward. So then I would make like a manual adjustment and sort of reduce the expense in the budget next year because it was taking those actuals and accounting for those big one-time things and adding it back to the next year. But this, effectively gets us a budget. And so this is a critical document that basically throughout the year, then when I look at the actuals, I'm going to be comparing it to this budget. And anytime there's a big variance, I'm going to say, okay, I think there's a big issue here. And that'll, sort of allow us to do very quick financial analysis throughout the year with a, clear sort of source of truth. So the next area I want to talk through is the recurring cash flow analysis area. And as I mentioned, this ties directly to the budget. And this is really a process that should be happening ideally monthly and maybe quarterly, but should happen multiple times throughout the year. So what is this? It's really the process of performing a recurring cash flow analysis for each property through a comprehensive budget to actuals analysis, can be referred to as a BTA, on every single income and expense line item, ultimately to understand what the actual debt service coverage ratio is, right? And so we want to go through, compare the budget with the actuals to understand any variances. And if there are variances, we need to develop a strategy to, understand why that is. And the DSCR is very important because, as we've discussed already, it's a critical asset management principle. Property is really considered financially sustainable if it has a DSCR greater than one. Of course, we want a DSCR that's, at least 1.1, but as long as it's above one, it means we can cover all of our debt obligations. And so the purpose of this is it really allows us, A, to identify line items that are misaligned with the budget. And so the BTA analysis can show us, it can be used as a basis to really inform the entire asset management department. It can show us if there are discrepancies between the budgeted income and the actual income and why that is. And the same thing with expenses, and it can show us the specific line items that are causing that variance. And the DSCR just gives us a good sense of the overall health of our portfolio, right? It gives us a quick number that helps us understand like how much of a cushion do we currently have between our net operating income and, our debt service that we need to pay to our lenders. And so again, I tried to lay out some, very simple objectives that are needed in this process to do it effectively. So number one is again, you want to be timely with it. You want to do this analysis ideally on a monthly basis for the entire portfolio. And ideally you have a tool that, shows the budget versus actual every month and highlights the large variances. And, we'll go through an example right after this. Um, Number two is around each line item. You want to develop an action plan each period for any line item that there is a large deviation from the budget. And so, let's say, for example, anything that has greater than 20%, but that's just an arbitrary number. But really, you want to make sure, okay, if the income is way below, how do we increase that? If the expenses are way above, how do we decrease that? So you need to not only do the informing analysis, but you have to develop an action plan to actually make the changes to ensure that in the next period it is better, right? And so for each property, you want to create number three, right? You want to create a strategy for any property that has a DSCR less than one to ensure a clear path to a DSCR that is at least greater than one and ideally greater than 1.1 or 1.2. And that's very connected to number two, but you want to make sure that action plan in number two actually leads to a scenario where if you succeed in all these things, the property does have a DSCR greater than one. And then across the portfolio, you want to just continue urgent and action plan strategy creation until each of these properties ideally achieves a DSCR greater than 1.1 or 1.2, and then continue to monitor that over time. So just to summarize, it's very critical informing analysis, but you have to make sure based on the information to you that you're actually creating action plans to get each building above at least a DSCR of one and ideally above 1.1 or 1.2 in the long term to make sure you have the cushion that you need to operate in a more proactive way. Now I want to walk through an example of, sort of performing a, recurring cash flow analysis, and we'll use the exact same property that we did in the budgeting exercise and the same budget as well to compare it to. And so for this example, we created a 2026 budget. Now we're going to do a 2026 full year financial analysis. And so the first piece of information that you need to organize is getting the actual income and expenses by line item. Ideally, right, the same chart of accounts we use for the budget is what your actual financials are in. It allows for a much easier comparison. If they are not, you might have to reconcile some of the numbers and put them in categories that are the same as your budget so you can very easily compare. And so I have the actuals here. And so we start with the actuals. And then the next thing is we want to put the budget right next to the actuals. And so this is the budget, the same static budget we created in the fall of 2025. We're now comparing at the end of 2026 to the actuals. And so I put these side by side next to each other so we can see the difference. I think it's very helpful to actually create a separate column that actually shows the gap as opposed to just trying to look at it by just looking at the actual and budget. So I've set this up in a way now where the gap is basically taking the actuals minus the budget, so it's showing the difference. And another helpful tip I would say is to, ideally color code this in a way where green shows a positive variance and red shows a negative variance. And I also set it up if it's a big variance, it's also highlighted. This allows you like really quickly, especially if you're doing this across an entire portfolio, to understand where the issues are and where the big variances are and what has to happen. And so now that we have all the data here, let's walk through this line by line. So starting with residential income, we can see, okay, gross potential rent was pretty close, a small gap. That can happen if there was a lease up at a slightly different rent, but nothing of concern. We look at vacancy loss, we can see like vacancy loss was significantly bigger. And so that would be the first question, like, why was that? Were we aware throughout the year or were we not aware? And so in this scenario, no, we knew there was, a long-term tenant who had been there for over a decade that moved out. And so their unit required a very long term because it had a lot of old appliances. And so we had this in mind throughout the year and made sure things were going to work regardless. And so this makes sense to me. This is not a surprise. And then we continue down, bad debt, very close to the budget again. We can see total income. There's definitely a gap, and that's caused by vacancy. All these other income sources are pretty small and they're pretty close to the budget. We're budgeting very quickly, adding inflation. It's common for these kinds of variances. So overall income we can see is lower than the budget, and this is really driven by the vacancy loss, which we did expect. So all of this sort of pencils. Now let's go to all the expenses. So right away, we can see for repairs, there's a pretty large gap between the actuals and the budget. So we spent significantly more. And so when I think about this, yeah, we had that big unit turn I just talked about, and that really increased but I didn't expect it to be this much over the budget. And so really this is just telling me that going forward, we need to be a lot tighter around basically approving any sort of maintenance and repairs in this building next year because we're just spending too much right now. And this is good context for me as the asset manager. So when our property managers are sending us stuff next year, I'll know that, I have to be a little bit more tight on approving things and looking for cheaper alternatives and only if it's really necessary. And then we continue down, garbage and janitorial, pretty identical to the budget. Good to see. Pest control, so we actually spent less. And yeah, this I would expect because, we typically plan for maybe one bigger pest control issue, and we had nothing this year, so we only spent money on our monthly service. So that's great. Elevator, we spent a little bit less. That's good. Overall, you can see maintenance and repairs, we're well above the budget, and it's really driven by this repairs issue that I know going forward. And so now looking at utilities. So water and sewer, wow, we spent, close to $6,000 above the budget. So this is very concerning. I was not aware of this throughout the year. And so this is something that like you clearly as an asset manager, this is when you have to develop an expense reduction strategy. Um, quick brainstorming. This could have been one major leak. This could be a bunch of small leaks throughout the building. I'd recommend getting your property managers and your asset manager and basically walking through every single unit, potentially also with a someone who can do quick repairs to understand where is there any big water issue. Because this is definitely a big variance into the utilities. They should be pretty close to the budget unless there was a big issue. So this would be a concern. And this is why it's better to do this on a monthly or quarterly basis. So I could have caught this as opposed to now I'm doing a full year analysis. This could have started in January, February, and I'm now just seeing it. So that's an area I'm going to look into and dive deeper into, right after this. Let me go to management fees. These are specific numbers that we have to go by, so they're going to be pretty precise. Our property managers, it was $2 less than I projected, so nothing big there. And then going into the next category. So you can see insurance was actually a little bit less than the budget. And this makes sense because we planned for a 10% increase as opposed to, a 3.1% increase. And so clearly it made sense to do that. And now you can see we are closer to the budget. And so our broker was correct. Other ones seem very in line with the budget. And then we look at legal. So we spent much less than the budget. And so that's good. And that makes sense because we had very little big legal issues this year. And that's positive. You want to minimize legal issues, of course, for cost. And also, those are typically not great for, the lives of your residents if you're getting into too many legal issues. And so there's some savings there. Then we look at replacement reserve. So this should be the same because we have compliance and it's supposed to be exactly 2,400 a year. And so if there's even a $10 discrepancy here, I would say this is problematic and we need to figure out what went wrong here. Is this an accounting issue or did we accidentally transfer the wrong amount of money, etc.? But it's the same here. And then we look at total operating expenses. So it's a little bit higher. You can see by 2000 that makes sense after doing the analysis we did. The repairs issue and then this big water and sewer issue that we have to figure out, but we at least know where the issues are because we have this budget to compare it to. It shows us very clearly. Then we look at debt service, which again, if you have fixed constant debt, there shouldn't be any gap here. And there is none here. And then we look at the overall DSCR, and you can see the actual DSCR is lower than the budget, but it's still above one. So I feel good about that. There's sufficient cash surplus to cover our debt service, and it is a little bit below the budget, but we know exactly where the issues are. And so I'm going to be mindful of repairs going forward next year and just being tighter. And then immediately I'm going to reach out to our property managers and set up time for us to go unit by unit to understand and find any potential water issues. And hopefully between all of that, we will get it to the budget or better going forward. And so that's kind of a standard cash flow analysis, really just comparing the actuals with the budget, looking at the big variances, the things that are bad, understanding why that is, if we were expecting that, if not, creating an action plan around how we can understand what the problem is and how we can fix it. And it's good to do this on a monthly basis. And ideally, if you have the same chart of accounts for all your buildings, you can actually just have all of your buildings in one spreadsheet. And you can even have a total column at the end. And so you can also understand then if there's potentially consistent issues across the portfolio, you may have to develop a larger sort of macro strategy as opposed to just looking at the property level. So yeah, that is the end of our asset management presentation. Just to bring us back to the definition that we use, it's really the strategic oversight of properties and resources to ensure, number one, their long-term financial sustainability. Number two, regulatory compliance. Number three, doing all of this in alignment with the organization's mission. And so asset management, as we've discussed, is a very high stakes department just because there's financial and compliance associated with them. And there's a lot of different areas. So really important to invest the time and energy in understanding all of those different key areas and responsibilities. I know I ran through a lot of them very quickly. So definitely recommend, diving deeper into all of those different areas to make sure your organization is operating in a financially sustainable way and following all the different compliance guidelines associated with your properties. Thank you.